Hey, this is Bill Beaudry from MarketTimingResearch.com, and it's the beginning of the year 2012. So I want to show you how we use our seasonal software to come up with our seasonal forecasts that we feature each month in our Factor seasonal newsletters. We have 3 newsletters. One is a newsletter for the Dow Jones, which predicts the upcoming seasonal pattern or trading pattern for the stocks in the Dow Jones. Next is the S&P 100, the most the largest traded, most liquid stocks in the S&P 100, and then the NASDAQ 100. And we just focus on those particular stocks because they're the ones that have, the most options liquidity, the largest stocks, and those are the ones that a lot of options traders like to trade. So we get a lot of fund managers and options traders. They love this information because you're going to see it gives you a lot of inside information, sort of an unfair advantage over expectations as to what the market's going to do. Now, the whole idea of seasonal trading is that stocks tend to repeat a typical trading pattern over various years, and that's because of the economic cycle or the annual cycle of a particular stock. We take this one step further in that we say if there is a particular economic environment, such as increasing inflation rate or a decreasing rate, or it's a loose monetary policy, or it's a bull market or a bear market, the trading pattern of that stock, of course, will be different than it is during a different economic period. So, of course, let's take a look at the Dow Jones to get an idea of this, all right? Now, our particular software, and if you get one of the versions of our software, it's really easy to use because it just uses Yahoo data. You don't have to buy any data feed at all. Just type in the symbol that Yahoo uses. It goes and it gets all the data from Yahoo, and that's all you need. So it's really easy to use. So what I'm going to do is I'm going to relabel the chart here, and we just relabeled it Dow Jones. And this is starting in 1956. That's what this year is up here. This is the annual seasonal pattern if you use all the stock data for the Dow Jones since 1956. And you can see that most people, if they're using this, are going to expect a low right around this point in time. And if we watch this date here, that's around January 23rd, and somewhere around May 1st or 2nd, they expect a peak. And most people, what they try to do is they try to buy around here, and then they have this old idea of sell in May, go away. Well, we can do a better job than that, all right? What we do is we come up with our orange projection line, which is an adaptive forecast. And this is using all the years of Dow Jones data, and this is suggesting that the low is going to come in sometime here, and that the peak for this year is going to come a little bit earlier than that May period. It's going to come a little earlier than that. So of course, when we get closer to this time period, this is going to change because we're going to get more accurate data, and we're going to pick the years that more closely look like a market. But using this adaptive type of analysis, we can get an expectation for when the highs and lows of the year will be. And we can use that to create trading setups. So for instance, if someone is expecting this to be the pattern of the Dow Jones right now, and you can see this little yellow line is the actual price pattern, what they would do is they'll say, all right, I expect there to be a low in January from this chart. How do I trade it? What they'll do is they'll possibly draw a trend line on it, or they'll wait for a MACD signal or a Fisher transform signal on the upward side to use as a confirmation of the trade. And if it reverses, of course, then they'd get out. Now, we have the capability with our software of taking a look at a large number of factor seasonals. For instance, how does the Dow Jones usually trade in recessions versus business expansions? And you can see that even if it's a recession, the market tends to bottom in January, a little earlier than during expansions, around January 11th, and then it tends to go up, and then it tends to make a double dip here, all right? So this is a factor seasonal chart, and you can use this to help pick tops and bottoms and little pivot points that you can use for your options trading, or periods when you should be very careful and raise the stops on your particular stock. And you can take a look at the inflation rate seasonal. Of course, this inflation rate seasonal only has a 28% correlation to the recent market behavior, so it's not explaining the market at all. The market is not trading according to seasonal, so you wouldn't be using it. But if you were trading some stock like the oil stocks, which are very, very correlated to the inflation rate seasonal, especially the rising seasonal, you'd be looking for a period of the market bottom around this period of time. All right, so our factor seasonals that we put in our newsletter every month show this type of information. But the first thing that we usually have to do is we want to figure out how many years you would use to come up with your seasonal chart. All right, that's one of the other factors that makes us very different from other people who are just basically trying to come up with the 2 dates during the year where you get out and you get back in the market. We can use this for every particular stock that has a seasonal, and it's very adaptive, so it tells you whether it should be early, whether it should be late, and the fact that you can confirm it against factor seasonal charts such as business cycles and so forth it makes this incredibly useful for fundamental traders, technical traders. It's just amazing information, and that's why we're so uncannily accurate at sometimes. Sometimes we pick the tops to the day, though you should never really expect that. You should just expect the seasonal. You want the seasonals to give you an expectation of the time period for a top or a bottom or a wiggle, and it can come earlier or later. But then what you do is, now that you have an expectation and the stock is trading according to that seasonal that has appeared several times in the past, then what you do is you set up a price signal around that to confirm an entry or an exit from the market. And that's all you do. We never want people to become stock traders. We just look for people who are already trading stocks or options, and we give them the information, hopefully, that they can become better stocks and options traders. And the way you do that is by reducing the number of stocks that you're trading, that you're looking at, the number of positions that you're handling, and number 2 is stop over leveraging. Okay, don't bet it all on one particular vehicle. So when somebody does seasonals trades, even seasonals are wrong. We suggest that you do 2 or 3 or 4 or 5, and that's about it. You just go through our newsletter every month, which goes through 100 stocks. You usually find 30 or 40 that have a seasonal pattern that are following. You pick the patterns that you like, that you think you can follow. Just follow those stocks. If the market behavior or price triggers a signal for that particular stock, it means it's going along your expectations, so you can get into the trade. Only deal with a few number of those, and you'll usually do fine. All right. No guarantees, but that's what we usually. That's our particular trading methodology. This particular analysis here, I'm determining how many years we should be using to be doing our seasonal chart for the Dow Jones, and actually it's telling us we should be using all data. So we were right just with this chart alone. If we actually change the number of years of data, you can see that we used to create the seasonal chart, even though we're decreasing the number of years of data, they're all saying that somewhere in January there's usually a low. It's the data is changing, it's becoming later, and you can see that this we're getting a second bump in here, okay, in March. All right, here's one. If we're only using the last 5 years of data, this is where this is what the seasonal forecast is. That nobody would be even trading this here. You'd be trading it here. But right now, our analysis is telling us that this is at this point in time, this is the best guess as to the chart that the market is going to be following. All right, and as we get closer to this time period, of course, if the market follows this exactly, it would tend to confirm it even more, and if it then goes up, it tends to confirm it even more. But the basic pattern of it tells us which particular number of years that seasonal pattern it tends to be following, and that's what we show in our newsletter. So if we were to take a look at a stock like Cisco, all right, this is the seasonal pattern using all the years since 1991. So that's about over 20 some years of data, 22, 23 years of data. All right. Normally, this is the normal seasonal pattern most people would expect is this green line here or here. And you can see our orange projection line, which we're not telling you to use, but that would be saying stay out of Cisco right now. Okay, some people would be short sellers here. And we're not recommending that because we're not financial investment advisors and we're not telling you what to do. This whole video is for educational purposes only, all right, explanatory purposes to tell you how we do our newsletter, how we create our newsletter. And this is where people would be looking for this particular low, all right? But if we were to basically do our analysis, first we're going to see how many years we would use to come up with a seasonal chart for Cisco. And our analysis would tell us that we would be using 15 or 20 years. 15 or 20 years Cisco, 15 or 20 years worth of data. Okay, so if we do our seasonal chart for 15 years, this is not a stock I would be buying right now personally. And you can see this is something that a lot of people would be selling, or they would be writing, raising their stops on, or they would be writing or buying puts on, or writing calls on right around this period of time. If we change it to 20 years, okay, and then for our newsletter we do a little bit more analysis to tell us whether it's 15 or 20 years. We're getting the same sort of general pattern, okay? So this is basically telling somebody, hey, I would not be bullish on Cisco right now. Does that mean that Cisco will have to follow this pattern? No. But if you hear Cisco in the news and everybody's pushing it, when you do the seasonal pattern, you just check our, you check our newsletter for, what's the Cisco pattern. If it's following that pattern, and if it's something like that, you say, geez, just ignore all the news. People are just trying to hype it. All right, let's do another stock, okay? Let's do something like energy. So the first thing we do is get our data. There's energy, and this is the normal seasonal. It's going straight up. So a lot of people are, long-term bullish on energy. If we do our seasonal analysis, and we just do default all the years of data since 1982, you can see some people are going to be buying here, or here, or here, or here. All right, this is the normal sort of seasonal periods that people would be expecting bottoms. What we do is we go and we check our analysis for the number of years we would be using for energy. Let's just make sure it's energy. Yep, ETR. And we would be using 8 years of data. All right. So with energy, we would be featuring in our newsletter this particular chart. And this particular chart would be saying, would suggest to a lot of people, and once again, I'm not telling you what to do, that this is where the possible low is coming. So a lot of people would be avoiding this stock until this period of time. You see what I mean? That's what we do this analysis every month for every stock. And the other thing about energy is we can take a look at energy. I saw in there that the recession seasonal, factor seasonal, is explaining energy stock market behavior prior. We can do this. Okay, you can see this prior to January. The recession seasonal is the one that's really explaining what's going on better than the expansion seasonal, and that's also suggesting that this thing is making a low later in the year. So you can see some people are going to get in right here because they're going to be using this particular seasonal, or like I said, when we were doing our analysis for energy, okay, it's either this period or this period of time. Now, as we get to the March newsletter, which forecasts for March, we will be able to tell whether this is the time period you'd expect the low or later. But right now, this is indicating in general that it's going down anyway, so it's a trade that most people would avoid. So I hope you can see there's so many things you can say about how to use the seasonals. I'm out of words for the value of it. A lot of people are going to be selling calls. If they have it in their portfolio and they have to keep it in their portfolio. Some people are going to be buying puts, so of course you have to be careful about your volatility, time decay. In our particular market, let's see, we have, if there's a volatility, there's a lunar count. We have a lunar calendar seasonal that also tells us this and then this period of time are not that good. And then let's see if there was a volatility calendar. All right, this is the peak of volatility in general for that particular stock. So there's an incredible number of ways you can use this. Now let's do FedEx. So we get the information for FedEx because FedEx has done their big shipping season, and this is since 1981. So you can see here is the normal seasonal that most people would follow if they're using all the data. All right, our first thing is, don't use that. You can be fooled. All right, if we use our orange projection line, actually it's pretty good. It's matching it, almost exactly. So this is suggesting that right here is when people would be looking for a market bottom in FedEx, and so that what they would be doing is they'd be putting a trend line on it, or they'd be putting a MACD signal crossover on it and waiting for some signal in this period to get long, or they'd be looking for a Fisher transform. Some people would be, once it gets that signal, they'd be selling the puts, collecting a premium. Some people will be buying calls. Some people will be buying the stock, etc. Some people will be covering their shorts. All sorts of ways to do it. But let's take a look at how many years we should be using. We do all that analysis for you because a lot of people can't do this. It's a little complicated. It's our secret formula or whatever. We don't really explain too much how to do it in this particular video because you don't really need to know how to do it anyway unless you have the software. 15 years is how many we would be using. So let's see how that changes things. So bingo. So this is what would appear in our newsletter, and every month you take a look at the newsletter and you're just looking for patterns that you want to trade. Okay, and this particular pattern for FedEx, a lot of people are going to say, yes, I like this. And so they're going to be looking for a buy here. They just want to run up here. They want to make more than bank interest or 1 or 2% a month or whatever it is. And they're going to get out somewhere here or here. Now, normally people are going to be waiting this long, but somebody has the seasonal program or these charts is going to say, well, look, it's flat this whole way. Why push it? If I've made, money, let me just get out anytime that's safe. Or you might have your own particular strategy. It's totally up to you. And let's see if the lunar calendar seasonal gives us any extra information here. Well, that suggests that we might have, and you can see the lunar calendar is doing a better job at predicting than the regular seasonal for all data. That says April here in April. That's doing a very, very, that might be, you might want to hold it till April. So if we go back to the regular seasonal, it's suggesting this peak here and this peak here might be 2 periods of time where you possibly can hold it to get a little bit better price. So if you miss this, some people are going to hold it for this peak or that particular peak, that sort of time period, to basically write their calls or raise their stops or get out of the stock if they're a short-term trader, or buy their puts and so forth and so on. All we do in the newsletter is give you this chart plus any factor seasonal chart that has a high correlation to that particular stock because it's explaining it. So FedEx didn't really have anything in terms of factor seasonals that's explaining it. Here's the bull bear market chart. It's not really correlating to that either. It's just on its own. There's no real factor seasonal chart that's explaining it all. Let's check inflation rates. Well, the inflation rate seasonal is suggesting this, okay, that the market could be going down. All right. Then you have a quandary when you have something like that. Then you have to say, well, geez, do I trust the factor seasonal or do I trust this? Do I trust this chart or do I trust the, the inflation rate factor seasonal? So when it comes to a case like that, you have to use your own best judgment, which is what you have to do with trading anyway. And sometimes it all lines up, and sometimes it gives excellent caveat information saying, oh, you better be careful about that. All right, so that's why this thing is so useful. If we do Home Depot, our last stock in this short video, here is the normal seasonal most people would be trading. The default adaptive seasonal is also suggesting that there's going to be a low here. And you can see it's pretty much mirroring this. If we do our analysis, let's figure out how many years that we should be using. And we do this for every single stock. So if it appears in the newsletter, it has a seasonal that you can trade. If it doesn't, then it's 15 or 20 years. Okay, and it's 15 or 20 years we should be using. And also we should definitely be looking at the business expansion cycle because it's correlated to that factor seasonal. So let's take a look at 15 years. There you go. There's a very, 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 the bottom here, and then this thing is very slow up, and then it just goes sideways. Okay. And if we use 20 years, suggesting there might be a low here, and then just sort of nothing. So what you do is when you do this sort of analysis and you see a stock, you say to yourself, well, why should I risk it if there are other stocks that have much better looking seasonals? You see what I mean? So that's the beauty of this software. We just basically produce the charts, the best forecast, and here's the factor seasonal chart, now you can see why it's sort of flattish, because if we take a look at an expansion seasonal, it goes straight up right around this period of time, which is sort of matching this. But if, you know, a recession, we have a double dip or something or other, this is when it can go down again. All right, so that's why it's, you know, the chart is really flat right then and there. The only time that, but this is funny, during recessions, this thing keeps going up in March. Isn't that very strange for Home Depot? So if we took a look at this again, you can see we picked up that same time period, and then that's the period where it usually goes down. And this is a stock that basically, I have no reason to trade this stock, because what I'm looking for is, I'm looking for times or stocks where the seasonal is straight up or straight down. I don't want a flat period, and that's why when I go through the newsletter, you know, every month I'm looking for stocks with there's something dramatic. There's either something dramatic like, well, here's Pfizer, we'll do that off of the cup. You know, I haven't prepared this ahead of time, where the factor, here's one factor seasonal where it's either dramatically down or dramatically up during this period. The normal price seasonal projection is down. Let's take a look at Pfizer, okay? You have so many stocks to choose from. If you don't have to try to figure out what the exact forecast of a stock is, if all the forecasts show that it's not doing too well, why, you know, beat your head against the door? It's sort of ridiculous. Now Pfizer here, if we just do the default, is suggesting that the stock will keep going down until late February. All right, so okay, so that's information that's useful. If we do our correlation, and you can see that was, you know, tallying with our newsletter. And whether you use 10 years, which is what I like, anywhere from 9, 10, 12, 15 years, you're going to get the exact same pattern, so to speak, whether it's all, you know, 25, 20, 25 years, whatever. In which case, I like to use 20 years. And let's see. Yeah. 20 years worth of data. So let's take a look at 20 years worth of data. This is that's what we would feature in our newsletter. Okay. That is the chart that we would be featuring in our newsletter. And if we take a look at this, for 25 years, it didn't really change too much. 15 years, didn't really change too much. Everything's sort of focused around that period in time right here. All right. But this is what we'd be using in our newsletter. I would not be personally a buyer here. I'm not telling you to be a buyer or not be a buyer. I'm not giving you trading advice at all in this newsletter. Remember, it's in this video, it's all just educational purposes. But you can see that this is the time period where a lot of people are going to be looking for setting their buy triggers for Pfizer. You know, it might be a little earlier or a little bit later. Okay, and let's see if the lunar calendar gives us any extra information on that. No, it's not really giving us anything special on that particular stock. And let's see if the bull market or bear market seasonal is telling us anything. No, it's just basically saying, oh yeah, here you go. Even when bear markets, there tends to be a bottom right here, and it's catching that particular whip right here too. So this is information that most people never see because they don't know how to pry apart the years that don't matter when you're, you know, past trading years whose history doesn't matter when you're trying to analyze Pfizer, and they don't know how to look at Pfizer under different economic environments like inflation rates or monetary conditions and so forth and so on. So that's how you use our program. That's how we use our program, and every month we do that. We come up with, a variety of forecasts for different stocks. You can see this was done over a week and a half ago. So a lot of the data has changed and made the forecast change, where as previously we were saying that the low might be in February, now it's moved later. It doesn't matter, because as we get closer to that time period, our forecast tends to get more accurate. But this is basically showing you anyway that you just want to stay away from the stock. All right, that's the whole, you know, business. And here, both of them were suggesting that the market will, you know, go down directly starting from the beginning of the year. Here, this is just a little bit off here but that's your regular seasonal. What we want is this orange seasonal, and that'll be the second or the third of the year. And sure enough, they expected a little blip up, and then the market would tend to start going down, and that's exactly what's happening with Pfizer right now. So it's following the seasonal right now. We expect to keep going down using seasonal analysis, and this is the chart that we would put in the newsletter. So I just wanted you to see how we do this. This is every month we analyze all particular stocks in the Dow Jones or the S&P and the NASDAQ. There are those that are following their seasonal patterns, and that's category A, and those that aren't don't even appear in the newsletter because you wouldn't trade them. If the stock is following its seasonal pattern, we show you the best seasonal forecast that anybody can possibly get, which is our orange projection line. We do all the analysis that tells us the number of years, and I'm not showing you how we pick the exact number of years because that's our proprietary algorithm, our little secret sauce. And then for some stocks, they happen to be following their factor seasons. They happen to be following the pattern that the stock would usually make in some special type of economic environment. For instance, Pfizer here is following, in general, the seasonal that it usually follows during recessions. It's following the pattern it usually follows it makes during recessions, which is why it's usually which is this red line, which is it's going down. And so if it is following a factor seasonal chart, we put that in the newsletter. And that's why this is so valuable. So you can see this. Here's one of our newsletters where we show you that is the factor seasonal until around March. That's usually during recessions. That's usually where it ends. Maybe that is the quarter ending, or maybe they're citing earnings or releasing earnings at that time. I don't really know. I don't follow Pfizer specifically. But anyway, you can see how technical analysts can use this. Fundamentalists love this because there's no other method out there that explains how a stock trades under different economic environments. Here's the typical pattern of the stock trading because that stock has a different fiscal behavior or economic behavior in recessions versus expansions versus different, loose monetary policy versus high inflation rates versus low inflation rates versus, all those things can be segmented out. You can see how a stock typically trades to come up with better trading decisions. And it's all done for you right here on our market timing newsletters at markettimingresearch.com. It's markettimingresearch.com. This has just been an explanatory educational video. Once again, we are not recommending that you make any particular trades. We're not investment advisors. We're just analysts that have done our darndest to produce the best forecasts of stocks that anybody can possibly do. It's better than cycle analysis, Elliott wave analysis. Options traders love this. You can't, you just can't work without this. It's incredible. And we just hope that you go there to our site, get a subscription for there's no risk, try it for free, and you'll just see how this will just revolutionize your trading.
The one-click trading feature allows you to open or close a trade with just one click. Once a trade size has been entered, clicking once on the buy or the sell price will send the order straight through for processing. You will not be asked to confirm the order, it will be placed immediately. You can activate one-click trading via this icon in the top navigation toolbar, or alternatively via the order settings. Once you have carefully read and accepted the terms of use, one-click trading will be activated on your account. By default, you can place one-click trades on all streaming price buttons within the platform. However, you can choose to enable one-click trading within the price quote windows only via the one-click settings here. When using one-click trading, any advanced order settings, including save ticket quantity, boundary levels, custom stop order triggering, and forward settlement behavior, will automatically be inherited from your personally configured order settings for the relevant CMC product. By default, your personal stop-loss order and take-profit order settings will be applied to your one-click market order. These, however, can be disabled separately here. Once you activate one-click trading, you can choose between 3 modes within the main toolbar, including single-click, which is on as default, double-click, or the locked feature. Locked will disable one-click trading for those times you are simply monitoring the market. If one-click is activated on all price buttons, when you move your mouse over any live streaming price, a one-click ticket will appear, allowing you to enter a trade size. The price quote windows will now also include an order size entry field. You can enter the size manually, or you can use the drop-down menu to select from a number of preset trade sizes. If you have selected to have Save Ticket Quantity by Product enabled under the order settings, the price quote panel will be pre-populated with your previous order size in the relevant CMC product. If you have not traded that product before, it will be left blank. Depending on the units or stake size entered, the price and spread displayed within the one-click ticket will display the live price from the price ladder corresponding to the number of units or the stake size entered. The price depth level indicator will be displayed in the bottom corners of the one-click tickets and also the quote panels. If no units or stake size is entered, or the market is simply closed, clicking the price will load the full order ticket. Depending on the mode you have chosen in the main toolbar, a single click or a double click on the buy or sell price will immediately place the trade. The mouse icon will change when you hover over a live streaming price to reflect that one click is live and the mode chosen. After you place or close an order using one-click trading, an execution alert will be displayed in the top right of the platform, showing the price at execution, the size of the trade, any associated stop-loss orders and/or take-profit orders, and the realized profit or loss for any closing orders. Please take time to read this to ensure your order has been executed as expected. This confirmation will automatically fade after a set period of time. One-click also applies to closing open positions or trades, or even cancelling pending orders. Simply click or double-click the red X icon next to the position or the trade you wish to close, and the trade will immediately be processed without the need to confirm. It's important to note that you will not have a chance to cancel orders once you have clicked a buy or sell price, so please take extra care when using one-click trading, as there is an increased likelihood of an order being unintentionally submitted. Please note that before you can use one-click trading, you will need to carefully read, then accept the one-click trading terms of use.